Good morning. It's a great pleasure for me to be here in Berlin again at this rather interesting time for the world economy. And because it's so interesting, I've had quite a job to try and select topics for me to talk on. There are quite a few competing, and I've decided on these. I'm going to start off by saying something about China, what's happened over the last several months and the extent to which we should be worried about it. I'll talk about the economics of low oil prices, the impact on the world, say something about the recovery in America, and then move on to the EU and say whether I think the Eurozone is headed for some sort of sustainable recovery or not. And then lastly, I'll say something about Brexit, that's to say the possibility that the UK may leave the EU. But it's with China that I'm going to start. As you all know, confidence has been really rattled over the last several months, on a number of occasions actually, by developments in China. And I think it's very important for all of us in business to get a clear perspective on whether or not this is fully justified. And in essence, my message to you is that it isn't fully justified. I think the world's markets have got themselves into a bit of a tiz-was about China. That's not to say that there hasn't been an underlying slowdown in China. There has. And it's not to say that there aren't severe structural problems in China. There most undoubtedly are. But that's not, frankly, the sum total of the market's mood over the last few months. The market got to the position where it thought that China was heading for a serious crash, essentially, with very serious consequences for the world economy. And those worries were, I guess, focused for a time at least on the Chinese stock market, which I show you here. Now, when you look at this picture, do you really see a market that has fallen dramatically? I don't. What I see is a market that was pretty steady for a long time, then underwent, frankly, some sort of boom, bubble, and then a correction. And that's all. Chinese stock prices went balmy at one point. They then adjusted, and of course they're volatile as markets are in countries growing as fast as China. Frankly, this is not going to upset the world economy. It's not even going to upset the Chinese economy. Something like only about 1 in 30 Chinese people own stocks in any case. I say we know that the Chinese economy has been slowing. In fact, there's a lot about China we don't know, apart from the fact you can't believe the official stats. At my time, many moons ago, when I was chief economist of HSBC, we used to be given the GDP figures several months in advance. And the worrying thing is that, unlike our forecasts, they were right to the point one. Here we see the official Chinese GDP figures year on year, the red line, and they've been coming down from a peak of more than 14%, would you believe? 14% growth at some point or other. They've been coming down. As you can see, they've been coming down actually in a suspiciously smooth way. Next to no professionals in the business believe that these numbers are accurate. Accordingly, at Capital Economics, we construct our own proxy indicator of Chinese economic activity using things like, dare I say it, hotel activity, electricity production, transport volumes, and so on. And for most of its time, this proxy measure, shown here by the blue line, as you see, has moved quite closely in line with the official GDP numbers until the last few years. And according to our proxy, and indeed to other people's proxies, the Chinese economy has been a good deal weaker than the official numbers have suggested, and of course more volatile. But look at the pattern of that blue line. What it says is that actually the big drop occurred towards the end of 2014, and since then the economy has actually been stabilizing. And so indeed I think it is. It's still risky, clearly, and this view I'm putting forward to you is by no means a certain one, but I think the evidence is that the Chinese economy has already stabilized, and that frankly markets have got themselves worked up unnecessarily about China. Now, of course, the Chinese slowdown has had a big impact, in particular on commodity markets. But just to make clear, China has not stopped importing commodities. The volumes that it imports has not stopped rising either. The volumes here of industrial metals imports, shown here in red, the volumes have continued to rise. The prices have fallen for a whole variety of reasons, so the value of China's imports of industrial metals has fallen very sharply, but that doesn't mean to say that China has stopped buying them or anything like it. Moreover, wage growth in China, okay, the rate of increase of wages has come down a bit. Yeah, come down to something like about 7 or 8%. The fact of the matter is, this is still an economy that's growing actually quite healthily. Moreover, and this is a big difference between China and just about all other parts of the world, the Chinese authorities have got ample scope to act if I prove to be wrong and the Chinese economy softens very substantially. They've got quite high reserve ratios imposed on the banks, which they can cut, and indeed, as you can see from the chart, they already have cut a number of times. Their interest rates, unlike large parts of the developed world where interest rates are virtually zero or even negative, theirs are still decidedly positive, even after they've cut rates several times. So if you see distinct slowdown in China, expect a policy response. And of course, in the extreme, they can actually tell the banks what to do to carry on lending. Another part of anxiety about China recently has been the worry that the Chinese authorities are aiming at a huge depreciation of the exchange rate, that they want to get the renminbi weaker. If you focus for a moment on the red line at the bottom of the chart, that shows the exchange rate of the renminbi against the dollar. And the renminbi has, of course, weakened very substantially against the dollar. Unfortunately, or fortunately, depending on your position, that doesn't actually give you a very clear idea of what's been happening to the renminbi's overall value, because as we all know, the dollar's been strong against just about everything. So the fact that the Chinese currency is weakened doesn't really tell you a lot. The upper line, the blue line, shows the trade-weighted average value of the renminbi against a variety of currencies. Actually, far from falling over the last couple of years, it's risen. This notion that the Chinese have forcibly allowed or intended or helped the markets to take down the value of the Chinese currency is quite frankly nonsense. Let me briefly say a word or two about the impact of China on the world, because it is very disparate. Some countries are heavily exposed to China, others most certainly are not. This shows the percentage of countries' exports to, it shows the percentage of GDP of different countries' exports to China. So on the right-hand side, unsurprisingly, you see some Asian countries who have about 10% of their GDP accounted for by exports to China. And for those countries, what happens to China is, of course, of overwhelming importance. And at the other extreme, you have countries whose exposure is very low. My own country, for instance, less than 1% of GDP is accounted for by exports to China. Now, being British, we like to think that's a sort of badge of honour, but the other way of looking at it is quite simply, it means that we don't sell them anything. The flip side of which is we're not that exposed to what happens to their economy. Now, the second major topic I wanted to move on to is about oil. And China and oil are, I guess, the two big shocks, economic shocks that have occurred in the world's economy over the last year or so, and a lot depends upon what you make of it all. This shows what's happened to global oil production and consumption. Production, the blue bars, and consumption, consumption, the blue bars, production, the red bars. And you can see moving into 2015 that there were a few quarters when consumption was a bit soft, and the slowdown that happened in the Chinese economy was one of the factors behind all that. But the dominant feature that has caused this period of very low prices is undoubtedly the increase in supply. Increase in supply for a variety of reasons, most importantly the production revolution, the shale revolution in the United States. Now, a lot of people are under the impression that low oil prices can't last much longer because already the oil price is below the cost of production. I think, frankly, you've got to be very careful with that. Careful with what you mean by the cost of production, because there's a huge difference between the all-in cost, including all capital expenditure, interest, and so on and so forth, and the basic running costs, the costs of extraction, once you've incurred that capital expenditure. And I show them here in these two bars. The cash costs, the short-run operating costs are the red bars. The break-even costs, that's to say the long-run costs, including capital expenditure, shown by the blue bars. And I've shown you these two numbers for a variety of countries. On the far left, Saudi Arabia, and on the right, Canadian oil, and then next to it, Russian. And you can see there's this enormous discrepancy. Quite a few countries, even at $50 a barrel or $60 a barrel, are in trouble as far as all-in costs are concerned. But frankly, as far as short-term operating costs are concerned, even at $30 a barrel, all these sources of oil are able to produce and actually make a running profit. So at the moment, there's no immediate reason why oil prices have to rise. However, of course, if the price is below the long-run equilibrium value, the break-even value, then investment doesn't take place, and eventually the oil price then picks up. And that is indeed the view that we have at Capital Economics. Our forecasts shown here in blue. Now, of course, no one knows this. We all know it's horrendously uncertain. You could plausibly, I think, believe in a scenario under which oil prices stay very low for a very long time. Equally, you could believe in a scenario in which they shoot up. Our view, however, is that this supply revolution I've referred to is a fundamental change, making for a period of pretty low oil prices. However, the cutting back of investment, because the prices are so low recently, will in due course cause prices to rise, and as you can see, we have them moving up to somewhere between $60 and $80 a barrel over the next 4 or 5 years. Now, that's all very well, but I think there's a more important economic question about the effects of all this on the world. How important is it? I have to say here, I need to make a bit of a confession along with most economists. I got this largely wrong. If you said to economists a few years ago, or indeed anybody else, we're going to see $30 a barrel oil at a time when oil was trading at 120 and Goldman Sachs was forecasting it at $200 a barrel, most people would have said, oh, well, that's fantastic news, then we're going to have a world boom. In fact, of course, we haven't had a world boom. We've had really rather the opposite. We've had a lot of worries about the world economy collapsing back into recession. And what's more, a lot of people have said the reason for that is very low oil prices. This seems to be very odd, because for most of my career, there have been various times when oil prices have threatened to upset the world economy, but until now, it's always been high oil prices that have been the source of problems. So how could it be now that low oil prices are a problem? Is it that both high oil prices and low oil prices are a source of difficulty? It sounds counterintuitive, but I think for a time, actually, it can be true. The point is this: the effects of a big change in oil prices are heavily concentrated on producers. The losses from low oil prices are heavily concentrated. Oil production is much more specialized than oil consumption. The gainers from lower oil prices are spread throughout the world very thinly. They gain a very small percentage increase in their income, whereas the oil producers lose a huge percentage of their income. Now, here I show you the impact on a number of countries' GDP from a reduction of $10 a barrel in the oil price, Kuwait here on the left being the biggest faller. And now I'm going to show you the impact the other way around, the gainers from lower oil prices. And I want you to notice the difference in the scale. Here I showed you in the last chart, let's go back one just to remind ourselves of the numbers. Kuwait between 5 and 6% loss of income. All sorts of countries, the UAE about 2.5%, Algeria getting on for 2%, Russia about 1.5%. Now let's look at the gainers. The gainers are gaining pathetically little. The blue bars here are the emerging markets. South Africa is a big gainer from lower oil prices. Yeah, what does it gain? Just over 0.6% of GDP. So even if this whole thing adds up to zero across the world as a whole, which it does, the fact that the losses are heavily concentrated as compared to the gains means that people are forced to adjust. And of course, adjust they have. The impact has been, I think, quite severe. Nevertheless, there are gainers to offset these losers. And I think there's something in the idea that last year we saw the big losses coming through from lower oil prices, and we haven't yet seen the full effect of the gains on consumption. So I still believe, actually, that these lower oil prices are a good thing for the world economy, even though they haven't seemed to be so far. And indeed, low oil prices have been a real source of difficulty. You will have noticed that recently, when the oil price has gone up a bit, actually equity markets have strengthened. Very interesting. Exact opposite of what you would have imagined a few years ago. So much for those two important excuse me, factors that have appear to have gone wrong, namely China and the oil price. Let me now move on and say something about the United States, where various times in the last few months the markets are worried that the US is heading for a recession. I think this is wrong. A whole series of numbers, admittedly, are up and down and all over the place, but the underlying picture is that the US economy is, I think, fairly robust. It's robust in creating employment. It's true that if you look at the manufacturing part of the economy, shown here in blue, there are some signs of weakness, partly associated with the strong dollar and these various troubles in the world economy I've been referring to. But one of the most important indicators, I think, is wages. What's been happening to earnings, shown here in red. As you all know, for a long time, the average American has seen next to no increase in their real earnings. And over the last couple of years, even with the economy recovering, the rate of increase of their nominal earnings in money terms, that's hardly picked up, but it's starting to pick up. And I do feel that with the employment picture looking pretty strong, we're going to see earnings picking up, inflation picking up. The net result of all that is, I feel reasonably confident, dangerous thing to say as an economist, I feel reasonably confident that the American recovery is robust, and we're going to continue to see, not spectacular, but reasonable growth rates somewhere between 2 and 3% for the next couple of years. Now, of course, that does come along with a downside and a danger. That's to say, what may happen to interest rates. You'll recall that when rates rose at the end of last year, the markets had a few attacks of the wobbles, and over the last few months, some people in the markets have concluded that the Fed made a mistake. After the last employment figures, that view has turned again, and it's becoming more generally accepted that probably it wasn't a mistake and that interest rates will rise again. We think there'll be a couple more rate rises this year in the States, and moving into 2017, interest rates will continue to rise, probably reaching something like about 2.5% by the end of 2017. They're going to rise also in the UK, although not by as much and not as soon, but in Japan and the Eurozone, they're going nowhere except possibly down. In fact, in the Eurozone, they are going further down, that's to say, further negative. Now, on the Eurozone, what is the outlook? Well, I have to say, I don't think it's that good. This is one of my favourite charts. It shows GDP set equal to 100 at the beginning of 2008 in the world's largest developed economic areas, showing here Canada, the US, the UK, Japan, and the Eurozone. And so the extent to which you're above 100 shows the extent to which you've grown after the crisis and downturn of 2008-9. You see that at the beginning of the chart, all these economies were in the negative territory. They all fell in every case. Since then, Canada, the US, and the UK, in that order, have staged, well, not dramatic, but pretty reasonable and continuous recoveries, and I think they probably are going to continue to do that. Japan has not languishing at around about the 100 mark, in other words, output still pretty much where it was 8 years ago, and the Eurozone only just recently managed to push its head above the parapet and achieve some sort of growth compared to where it was in 2008. But of course, this disguises a multitude of sins, this average, this aggregate, big differences within the total. We focus for a minute on the so-called peripheral countries, Ireland, Spain, Portugal, Italy and Greece, which underwent severe difficulties a few years ago. The star performer here is Ireland, which has staged a dramatic recovery there, you can see in red, and I'm pretty optimistic actually that Ireland's going to be okay. It's widely believed this is because Ireland, as it were, took the medicine, wage cuts and austerity, I won't say willingly, but it only took a lot of medicine, and to some extent that's true. A large part of the reason for its strong performance, however, is quite simply that its economy is first of all very open, and secondly it's particularly open to two economies that have done well, namely the United States and the United Kingdom. Ireland's two biggest trading partners have been growing strongly over the last few years, and that's the main reason why Ireland has grown so strongly. Spain also, in the last couple of years, has been recovering quite nicely, although it's still down on where it was in 2008. And then you look at the others, it's grim. Italy, bit of recovery recently, and Portugal still well down. Italy about 10% down on where it was in 2008, and of course poor old Greece still languishing something like about 25% down from where it was at the beginning of 2008. Now, against this backdrop, I have to say, last year was a bit more encouraging. There were all sorts of positive signs in the Eurozone. GDP growth picked up, probably around about 1.5%. Consumer confidence and consumers' expenditure picked up. And a number of people thought, well, maybe this is it. Maybe this is the beginning of the Eurozone recovery. Unfortunately, I don't think it is. And already you can start to see signs of softening, both in the northern core in Germany and in the peripheral countries. Essentially what happened, I think, last year is that a lot of these countries benefited from the fall in oil prices I spoke about earlier on. Forced prices down in the shops, increased consumer real incomes. They reacted by increasing consumption, and that helped to lift Eurozone performance. Now that effect is starting to fade a bit in the Eurozone. You're seeing the growth rates fall back, and I'm not optimistic. China is also relevant to some extent here. It's not overwhelmingly important, but it's important a bit at the margin. In particular, it's important, of course, in relation to Germany. Here I show exports to China, goods exports to China, both as a percentage of total goods exports and as a percentage of GDP. Germany is the country on the left. Germany pretty exposed to China. Around about 2% of Germany's GDP consists of exports to China. So the story I was telling you earlier on about China, particularly important for Germany. Now, I haven't got time to go into all this in much more detail. If you're interested, do ask me afterwards, because there will be a time for questions. But before leaving the Eurozone, I didn't want to move on without saying something about a very important medium-term factor of great importance to your businesses, perhaps in particular. That's to say the demographic outlook, which is very, very striking indeed. Most of the time in economics we focus on these short-term things, you know, what's happening to demand, what's happening to production, interest rates, all this stuff. But as we move in beyond the narrow short-term period into 5, 10 years and more, what really counts is demographics, the sheer number of people. And this shows, not our forecast, actually, it's the United Nations forecasts, for working age population in a range of European countries: France, Germany, Italy and Spain. In France, the population is set to remain pretty much constant, may even over the long term move up a bit, and in the UK it grows a bit more than that. But in Germany, Italy and Spain, it's set to plummet. Now, all this, of course, on the assumption that there aren't large numbers of refugees or other migrants admitted to the European Union. This gives an interesting economic backdrop to the whole migration question. You could argue, and indeed lots of people have argued, that Europe, from an economic point of view, needs millions of more migrants to make up for the fact that the native Europeans aren't making many more native Europeans anymore, for whatever reason. From a narrow economic point of view, you could argue that. Obviously, there are other social and political concerns. But if we assume that there isn't going to be a huge influx of migrants welcomed into our European societies, then this demographic backdrop is, I think, the single most important bit of business information you need when thinking about what's going to happen over the next 5 or 10 years. Now, let me move on and beyond. Let me move on now to my last topic, which is Brexit. That's to say, the possibility that the UK is going to leave the EU. And as you all know, there's a referendum coming in June. Now, for the last few years, my continental friends have been asking me whether this is something they should take seriously. On the whole, they've tended to think it isn't, tended to disbelieve the notion that Britain could possibly leave. And I've been saying to them, don't be so sure. There is a serious chance that we will leave. This shows the opinion polls, the balance of those asked saying that they would vote to stay in the EU. And we've got quite a long history on this, going back to the mid-70s, as you can see. So observations above the line show a majority thinking that they're going to vote to stay. Observations below the line, a majority of people saying they're going to vote to leave. And there haven't been many periods when the leavers have been in a majority, but as you can see, over the last couple of years, there's been a distinct decline in the lead of those who want to remain. And although this is showing on exactly 50-50, there are some polls which come out showing the leavers in the majority. And they, like all polls, they go backwards and forwards. Different polling organisations produce different results. So, frankly, should you take it seriously? Yes. The polls are pretty much neck and neck, and I think all the evidence is this is going to be quite a close vote, and it's going to depend on what happens, the events that occur over the next few months, which way the vote goes. It is perfectly possible that we will see Britain voting to leave, in which case we all of us have to think what the consequences might be. Now here, of course, we naturally turn to economists to tell us what the answer is, at least as far as the economic consequences are concerned, and I'm pleased to be able to tell you economists know the answer. That's to say, we don't know. Or rather, people like me, the honest, clear, balanced, intelligent ones, say we don't know. Lots of others, I'm afraid, they appear to know rather too much. The trouble is, what they know differs from one economist to the next. Here I show you various estimates of the impact of Brexit on the UK economy as a percentage of GDP. Would you believe there are some people who think that the UK is going to lose up to 12% of its GDP, not in 1 year, but in total. 12% of its GDP by leaving, and there are others who think it's going to gain 12% of GDP by leaving, and all stations in between. So you pays your money and you takes your choice. Now, you might well think this confirms all your worst views about economists. They can't organise something or other up in a brewery. They can't even add up. Actually, it's not because they can't do their sums that there are these big differences. It's because there are some genuine uncertainties about the key factors involved. And I think in particular there are two major issues impinging on this question which are fundamentally uncertain. The first is, if Britain were to leave the EU, what sort of trading relationship would we have with the EU? Some people think it's going to be remarkably close. Indeed, some people think it's going to be indistinguishable from the current setup. If Britain, for instance, were to settle for the Norwegian option, under which we would remain part of the European Economic Area and the single market, what would the difference be? Next to nothing. So some people think that. And at the other extreme, there are people who think this is going to be a bust-up, rather like a very messy divorce. It's going to be pretty ghastly. Trade barriers are going to go up, not just the common external tariff, but other forms of discrimination. And again, all stations in between. We just don't know. So what you think the consequences are going to be depend very much on where you think the outcome's going to lie on that particular spectrum. And then there's the question of regulation. If you're an outer, you tend, for economic reasons anyway, the gains from being out tend to come most heavily from the ability to rescind EU regulations. What's that going to be worth? What are you going to save? Incredibly difficult to say. Assessing the costs of regulations, in any case, very, very difficult, but there's something more important here that makes this whole exercise even more hazardous. That's to say, okay, we come out of the EU, we've got the ability to rescind various EU regulations. Which ones will we rescind? Just because we can, having pulled out of the EU, doesn't mean to say that we will. So what assumption do you make about which regulations are going into the bin? Extremely difficult conceptually to come up with a hard and fast answer. So again, there is no single answer to this. Some people think it's going to be a bonfire of regulations, people on the far right, free market right, and we're going to rescind everything, hours of work, all the usual stuff. Others think we're going to rescind very little, in which case you end up with this big variation in estimates of the gains. Now, one area where you might think it's easy to be clear about the answer is Britain's contributions to the budget. I have to say, you're wrong even here. This is a nightmare too. In broad terms, Britain contributes gross around about £20 billion a year, net probably around about £10 billion a year. But there are all sorts of different issues here, and you are making different assumptions, you can come up with different numbers. And of course there's the question, if we were to leave the EU, would we still have to make some contributions to the EU budget anyway, as Switzerland and Norway do, even though they're outside the EU? So even here, there are uncertainties. I have to say, I'm in the camp that thinks that the impact on the British economy would not be very big, one way or the other. And I certainly don't think it would be a disaster if we were to leave. There are several reasons for this, but one of them is that trade with the EU is nothing like as important as it used to be. Goods exports to the EU, they're still very important as part of Britain's trade, but they're on a sharply declining trend, and I think they're set to go on declining too. What's more, the extent of the tariff that the EU imposes on goods from outside the EU has fallen quite dramatically, now down to about 4%. So in the worst case, if Britain were to pull out and we didn't get a trade deal and the EU imposed the external tariff, 4%? Really? Hardly a game changer. I mean, this is just about the average change in the foreign exchange rate in the course of a week, or in a bad day, even a day. A lot of attention is focused on the City of London, some people suggesting that if Britain withdrew, there would be a major blow to the city. And most attention is focused on so-called passporting rights. That's to say, the ability of a foreign bank setting up in London to sell its services throughout the EU. The EU lays down that in order to sell in the EU financial services, you've got to have a significant operation in the EU. And most prominent international banks choose that EU location to be London. So the suggestion is, if Britain withdrew from the EU, all these banks, the American ones, JP Morgan, Goldman Sachs and so on, and the Swiss ones, Credit Suisse, UBS and so on, would have to set up a significant operation somewhere in the EU, might be Frankfurt, might be Paris, might be Dublin, and accordingly they would have to move substantial amounts of business from London to that other centre. And they might even say, look, why do we need two European centres? If we've got to have an EU centre, it's got to be Paris or Frankfurt or Dublin, why don't we close down the London operation? And there are plenty of people saying something like that. And again, of course, were this to happen, it would have big implications for your business in London. It would have big implications for the office market in London, high-end employment, all sorts of things. My own view is this is unlikely to transpire in quite this way. I mean, clearly, there would have to be a relocation of some business from London to Paris and Frankfurt and possibly Dublin and Luxembourg. Clearly, these banks will have to set up some sort of operation in those centres, and London will be a loser from all that. But the idea that banks are going to shut down their operations in London, I find wholly incredible. I gather recently the French president and indeed the economy minister have held out the idea of a red carpet to welcome bankers to Paris. I hope what's inscribed on that red carpet is the top French tax rate. The idea that people are going to flock willingly to Paris or indeed Frankfurt is frankly bonkers. With the financial transactions tax stuck somewhere in the long grass, bonus caps, the fundamental fact that the EU Commission and other EU bodies just don't like financial services, the fact that there isn't the extent of support services in Paris, Frankfurt, Dublin, Luxembourg and so on. The notion of a wholesale exit from the city, I think, is quite frankly balmy. So let me come quickly to the conclusion, the impact of all this on the UK and then more widely. You know, the recent history is of the UK doing relatively well, not spectacularly well, obviously had a bad time during the financial crisis, but doing much better than the rest of the EU. I think, frankly, this is set to continue. We focus on the peripheral countries, the weaker countries, including Italy, which have not done so well. But the fact of the matter is, over the last several years, the big, strong countries, Germany and France within the EU, have not done very well either. They've been substantially outgrown by the US and the UK, which, despite their significant problems, have grown faster. And moreover, within the EU, there is, I think, a very worrying weakness which doesn't receive enough attention. That's to say, the increasing divergence between Germany and France, the so-called motor of the EU, which looks as though it's not only stalled, but frankly, it's been pushed off the road. Can this motor keep the EU show on the road, with France doing so badly compared to Germany? So, consequences of Brexit, should you take it seriously? Yes, you most certainly should. It is a very, very distinct possibility, if not yet quite a probability. Will it be devastating for the UK economy? No. The day after it happens, things will be essentially the same. There'll be a 2-year period of negotiations during which there'll be considerable uncertainty. I think actually there will be quite a good trade deal struck between the UK and the EU, because for both sides it makes economic sense. For both sides, the other partner is their single biggest export market, not just the EU for the UK, but the UK for the EU. So there's a strong incentive to reach a trade deal. I think there are bigger issues at stake here which might yet propel the British people to vote to leave, issues of identity, sovereignty, democracy, control, into which the migrant crisis plays perfectly. This is one of the reasons why I think there's a good chance we might leave. And I think the single biggest uncertainty here, I think you can forget the notion that the UK or London is going to suffer dramatically. I don't think it is. The really big issue and uncertainty, I think, is what the consequences will be for the EU. At a time of continued worry about the Eurozone, continued worry about the migrant crisis, if then the EU's second biggest economy, the UK, votes to leave, what is this going to mean for the EU? There is, I think, a significant possibility that over the next few years the EU is going to unravel. Now, I'm sufficiently polite and withdrawn not to tell you whether that would be a good thing or a bad thing. Thank you very much. I'm happy to try to answer questions if there are any. I gather that there are some roving mics. If there's a question here, if we can, two actually, if we can have some microphones. Actually, there are lots of questions. There are questions over there too, I can see. Gentleman with the red tie here. Yeah.
Hi, good morning. My first question, I just have two questions. I think the first one's answered pretty quickly. When you show those graphs of the economics compared to 2008 to now, is that done in local currency or is it all in one currency?
It's done in real terms. It's nothing whatever to do with currencies. It's volume.
Okay, but you have to have it in one currency, I mean.
Well, it's in a common currency.
Okay. And then the second question is, in your Brexit discussion, you avoided a key topic, which probably is very difficult to comment on, but the pound. What's going to happen to the pound in the case of a Brexit?
Well, there I can deploy a vital part of the economist's toolkit, which unfortunately I have to use really rather too often, which is that I haven't got a clue. And it amuses me, all these economists being wheeled out from American investment banks, trying to outdo each other. Of course, they're all about 13 on a good day. Saying, oh, it's going to fall by 20%. No, it's 30%, 50%, parity, below parity. It's all nonsense. I think there's... One of the characteristics I have is I say I don't know, and then I go on to give a view. So the pound's fallen a bit, of course, already. I suspect that it may well weaken further as the referendum approaches. The difference here is I don't think that's a bad thing. On the contrary, I think it's wonderful, because over the last several years, the UK has suffered from having too high an exchange rate for sterling, I would say. We've got a big current account deficit. We need to be cutting that back and increasing our exports. So if the pound were to weaken a fair bit further, I, for one, would be delighted. In fact, I think the problem facing the British authorities would be that if it did weaken a good deal further, how could they keep the pound low, whatever the the referendum result? How could they get it to settle at that new lower level? And I hope that they're somewhere or other in Threadneedle Street, they're burrowing away trying to find the answer. Another question over there. Gentleman here.
Thank you. Going to your last point about the potential of Brexit, is the referendum an academic question because the EU will fall apart in the next 3 years anyway?
Well, I don't think one can take that for granted. I thought it crossed my mind that maybe this is premature, that for the sake of good relations with our neighbours, the best thing would be not to hold the referendum so that we didn't have to leave something that was going to, in any case, break up. But we can't take that for granted. I mean, the fact of the matter is that this has been a running sore in Britain for many years. It's complicated relations between Britain and the other members of the EU. Although I know it's immensely destabilising, a lot of people resent having to have this referendum. I think it's healthy. I think we have to have this out once and for all. And I'm hopeful that if Britain votes to leave, we'll be able to have very good relationships with the remainder of the EU. There's another question somewhere around here. No, someone else had their hand up, I thought. Any questions anywhere else? Or have we reached a natural conclusion? Other gentleman there.
You said no worries about China. This morning we learned that the exports in February were minus 25% compared to February last year. Still no worries about China?
So it's very difficult for me to hear, I don't hear that question. I couldn't hear the question. I got the 25% exports, but I couldn't...
China. This morning we heard that the exports from China were down 25% compared to last February in 2015. This is not worrying, I would say.
No, I mean, I wouldn't focus, on 1 month's numbers in this way. I mean, it's highly, highly misleading. We've had several occasions in the last year of large monthly fluctuations. I haven't had a chance to look at those numbers. I will do shortly and see what they imply, but frankly, it's not the way to form a judgment on 1 month's numbers. Any other questions? If not, I'll round matters up. And can I close by hoping that these difficult events in the world economy don't cause your businesses too much trouble. Thank you very much.